Good evening, ma'am.
Good
Good evening. On behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the today's session on webinar on UPSC on ICoAS examination for newly qualified cost accountants. Our today's speaker is CMA Rashmi Mudgal ma'am. She is a practicing cost accountant. Now I request ma'am to kindly start the session, ma'am.
so much, Priyanka. I welcome you for this last session where we are going to discuss about the appraisal of projects, how we reject and we somewhere go with the costing, capital budgeting, cost of capital leverage analysis, method of project appraisal, payback periods also, and we are going to discuss about the benefit cost ratio. So today's session will be totally based on the what we have learned so far in this webinar. I'm sharing my PPT with you. Let me know if is it visible to you or not, please. Is PPT is visible?
Yes, ma'am.
Okay, so today we are going to discuss about the capital budgeting and what is the agenda for the capital budgeting. There are so many topics, but I have maintained so many PPTs for this. So today's agenda for the capital budgeting is introduction, methods, examples, benefit and limitations. Okay, so we are going to discuss about in depth of the capital budgeting, why we need it. It is basically a long-term uh, research where we actually see that the decision for long-term investment. Okay, so capital budgeting is to planning process which is used for the decision making of the long-term investment. It helps in deciding whether the project are fruitful for the business and will provide the required return in future years. Okay, so capital budgeting is definitely going to be a long-term investment. One thing, what we actually look into the capital budgeting, first is best returns, lowest cost, useful for the business or not. It is important because capital expenditure required a huge amount of fund. Okay, so before making such expenditure in the capital, the companies need to assure themselves that their spending will be bring profit to the business. Is this feasible or not? The capital investment bring the profit or not? Okay, so that is also there we need to think about. Okay, so this is also there. Also, the companies need to assure themselves that spending will bring the profit to the business, as well as investment in heavy machinery or big construction are example of the capital budgeting. Okay, so we are going for the key takeaways. What we will see from this capital budgeting first, capital budgeting is a crucial planning process used to making long-term investment decision, where we actually make a long-term decision regardless whether the project are expected to profitable and provide the required return later on. We actually see do it is making any profit or not in the future. Okay, so next it is important because capital expenditure requires significant funds. So companies must assure that payout generate profit before investing such cost in the capital. Okay, next is the payback period, discounted period, payback, net present value method, internal rate of return, and profitability index are commonly used for the capital budgeting decision. We actually go with some techniques where we can get to know what is the when we will get the amount our back, or is this which we are getting back, it is equivalent to today's value, or the back amount is also included the returns also. What is the time? What is the time frame for the investment? That is taken by these some techniques. That is five techniques. One is payback period, second is net present value, discounted payback period, internal rate of return, and profitability index. So these are the five parameters. We actually need to see all these parameters because every parameter is giving you a different story. Okay, so it is totally depend upon the taking the decision which is informed in which parameter we are lacking or which parameter is high score. So we need to think about that. Is this worth taking the risk or not? Is this a capital we are investing into some circumstances? Are we are able to get some output out of it or not? Okay. Next, we are going to discuss about the it is a decision making process where a company plans and determines any long-term cap, capex whose return in the term of cash flow are expected to be received beyond a year. So we actually don't think about the in year. We actually see beyond the year. There could be possibility where we are looking for the next 4 year, 5 years, 10 years plan. It could be possible that we are looking for the 20 years plan. So investment may decision may include expansion, acquisition, replacement, new product, R&D, major advertisement campaign, investment. So we think so it's not the explicit where we actually for the big vision investment. If it is a small investment which will result you into maybe in 1 month or maybe in a year, that will not being part of the capital budgeting where we actually look after the more than a year planning. Okay, this decision making remains in understanding whether project and investment areas are worth funding of cash through capitalization structure of the company's debt, retained earning, or capital budgeting, where we actually see choice out of. Okay, so capital budgeting process is a necessary and critical process for a company to choose between projects from long-term perspective. It gives the management method to adequately calculate return on investment and make a calculated judgment, always to understand whether the selection would be beneficial to improving companies value in the long term or not. Okay, therefore it is necessary to follow before investing in a very long term project or business. Okay, so this is totally depend upon the long term decision. This we have came with. So we can see here there are five methods which majorly used for capital budgeting decision. Analysis select the viability of investment. Okay, one is payback period, second is discounted payback period, third is net present value method, fourth is internal rate of return, fifth is profitability index. So what happened in the payback period, we are going to discuss one by one these all five methods. In payback period, we actually see are we getting when we are getting our investment back in how much period. Discounted payback period where we are actually calculating what is the profitability of what is the cost of money we are decreasing and what we are getting in the future. Net present value is something whatever we are getting in the future, what is the present value of today. Internal rate of return actually tells us about the return which we are already earning as a business. And third is profitability index, where we are actually discussing about what we are getting out of what investment. So this is the ratio basically. So we are going to discuss one by one for this. First is payback period. Okay, first is payback period. Payback period can be defined as period of time required to recover its initial cost and expense and cost of investment done for the project to reach at a time where there is no loss, no profit. Big even point. So we are seeing that initial cost of investment are coming, how much time we are taking to get it back to the organization. Okay, every investor, to be it individual or corporate, will want to assess how long it will take for them to get a back initial capital. The initial capital need to become again na, we understand that we wanted a return on investment, but also we somewhere think that my cost will recover in some period. So that period is payback period. Okay, shorter the period, the more favorable it is. So if I am buying a machinery of 7 lakh rupees, okay, and every year I'm getting 4 lakh rupees. So we actually somewhere assess that if I am buying this 7 lakh rupees, I will get my amount back within 2 years. Less than 2 years, I'm getting my amount back because 4 years, 4 lakh in a year I'm getting, and 2 years will somewhere sum up to 8 lakh. Okay, so this is the payback period we actually look after. Since the concept help compute payback period with the break-even point, investor can easily plan their financial strategy further and make more decision regarding next step. It is calculated by dividing investment flow received every year. This is valuable metrics for fund managers and analyze who used to determine feasibility of an investment. Okay. However, however, it is to be noted that the method does not take account time value of money. So if I'm getting 1 lakh today, and if I'm getting 1 lakh after 2 years, that means my 1 lakh will decrease the value over 2 years. Okay, so there is some value which will be decreased by the time of my money. Okay, that is not taken care by the payback period. What is taken care by the payback period? We can see here. What is the advantage? It is easy to calculate. First thing, very easy to calculate. Second, easy to understand. Very easy to understand. No? I'm getting 1 lakh rupees back every year. I have spent 4 lakh rupees. In my fourth year, I will be able to get my money back. Okay, so this will be my payback period. Help in estimate the project risk. So there is a risk attached to every project. So I can see here there is a risk of how many years, how many money is been risk on this. After 1 year, after 2 years, if I'm getting, what is the risk right now? Also determine the factors of for investment, where we actually discuss about the other factors of the investment also. Okay, so next is disadvantage. What is the disadvantage? It ignores the time value of money. First thing, if I'm getting 1 lakh rupees today and I'm getting 1 lakh rupees after 1 year, so there is one opportunity cost I am missing over here. If I would have a 1 lakh today, I would have invested it. I could have invested it, and could have a interest income, or maybe a share capital surplus. I do have some return on in my investment. So this 1 lakh rupees must have increased to 1 lakh 10,000 or 1 lakh 20,000 in a good world. Okay, so if I'm getting 1 lakh after 1 year, that means the time value of money has been decreased. Okay, fail to consider the investment total profitability. So we cannot see here what the profitability we are making out of it. We are actually looking for the investment to be returned. We are calculating it till the break even point. We are not thinking about what profitability I have made. Am I making 20%? Am I making 30%? My focus has shifted to the capital back, okay, not to the what return on investment I'm making. Okay, third is ignoring the need to invest in the long term project. For example, if I would say that my capital will be recover after 30 years, so who will wait for the 30 years? So people will try to go for the short term projects rather than the long term projects. So this is also a disadvantage. Does not take into account the social and environment benefit in the calculation, where we are not seeing that am I able to make more and more people work, or maybe I am increasing the employment, or maybe I can ignore that the previous machine is working same as, but I am making another investment but I'm making another investment just because of environment benefit. So this is also cannot be calculated by the payback period. Discounted payback period. It is basically what happens. Key time period required to recover its initial cash outlay, and it is calculated by discounting cash flow. What is the discounting cash flow? It is a return, and it is a return on investment, okay, that are generated in future, then totaling the present value of future cash flow. So we are discussing about the present value of future cash flows. So if we are getting 1 lakh rupees after 1 year, it means if 10% is the increase of my money, so I am getting 90,000 somewhere for today's value. So this is taken care by the discounted payback period. We can discuss about the formula. Formula for this: year before discounted payback period occur plus cumulative cash flow in the year before recovery and discounted cash flow in the year after recovery. So in the year before recovery, this discounted cash flow is given in the this is important because the prior year we can get a cash flow in the year before recovery and discounted cash flow in the year after recovery. So the purpose of this part is to find the proportionate to how much yet to be recovered. So next we can go with this example where I have put a firm would like to invest 1,50,000 into a project as an initial investment. As a initial investment, firm expect 70,000 in the first year, 60,000 in the second year, and 60,000 in the third year. So in the layman language, I could see that I'm getting 70,000 in first year, 60,000 in second year, and 60,000 in third year. So in the third year, I'm getting 1,90,000. Okay. So what will happen? In the third year, I'm getting a profit. In which month I'm getting my break-even point where my cost of investment is coming back to the company again. So what I did, I took the 1,50,000 as a negative amount, and this is the formula, which is present value is equals to future value divided by 1 plus interest into my n. Okay, so this is given into the question, that is 10%. That is 10%. So in the 0 year, it is 1,50,000 because at the time I'm paying it, the 1,50,000 value will be 1,50,000. In the first year, if I'm getting a profit or I'm getting an inflow of 70,000, then I assume that 10%, because of this 10% of inflation, or because of this 10% of discount, the 70,000 will become 63,636. Okay. And with the same calculation, with the second year, my 60,000 will become 49,586 of the today's value. And in the third year, my amount was 45,078. Okay, so this was 45,078. Okay, so this was the amount I'm receiving. So in the 0 year, I have spent 1,50,000. In the first year, 86,000. In the second year, it is 36,000. And in the third year, I'm getting an increase of 8,302. Okay, so this is the amount which I can divide after the amount. Okay, so in the calculation, I got to know that I am getting my money back in 2.82 years. I am getting my money back in 2.28 years, where I have actually somewhere considered the value of money also. Next is present value method, net present value method. So this is, sorry, net present value. What the net present value says that whatever I have invested, what is the value today, that in the previous scenario I have calculated the payback period, discounted payback period. But today I am discussing about, now I am discussing about the net present value. A net present value equation helps like user to understand time value of money. This data can be used to compare different projects and their profitability to decide whether the project is most lucrative to accept or not. In corporate securities, NPV is often referred to the discounted cash flow analysis. NPV can be calculated using tables, financial calculator, or spreadsheet. Okay. So NPV is most commonly used to estimate the profitability of a project, is calculated as the difference between the present value of cash inflow and the present value of cash outflow, the project time period. If the difference is positive, okay, it is profitable project, and it is a negative, then it's not worthy. So what we do, we actually look after, is it a positive, am I getting a profit from it or not, am I getting as per the return or not. If I'm not getting the profit, I have to drop this plan. Okay, so this is taken care by the net present value method. How to calculate it? Firstly, what we need to do, we have to calculate it. Firstly, we have to do identify the cash flow. Okay, determine the expected cash flow generated by the investment over the lifespan. Okay, how much time we are going to use this machinery, how much amount we are going to. This is more of a forecasting where we actually see what we are getting in the next year and what we are getting after that. These can include initial investment cost, operating revenue, operating expense, taxes, and salvage value. Select discount rate. Now we have to select the discount rate also. Okay. So in the discount rate, what I'll do, I'll see, uh, choose an appropriate discount rate that reflect the opportunity cost of the capital. What I can get with this capital. The required rate of return. The rate should consider the riskiness of the investment and the return expectation of the investor. Next is discount future cash flow. Apply the chosen discount rate to each future cash inflow, whatever comes, calculate its present value. So my present value will come. Okay. Next is calculate initial investment. What I have invested in the time zero. In the time zero, it will be calculated. So what happens? This analysis involve assessing the value of future cash flow from the investment or project today's term. Okay. So some present value, then I will sum add up the present value calculated in the third step, including the present value of the initial investment. This gives you a total present value expected cash flow. Okay, calculate then NPV. NPV is equals to total present value of the cash flow and present value of the initial investment minus. Then I will interpret the NPV. What a positive NPV indicates that investment is expected to generate more value than initial cost, potentially making it a worthwhile venture. A negative NPV suggests that the investment may not be financially viable. The larger the positive NPV, the more attractive the investment is. Decision. Now I have to see the decision. Okay. Use the calculated NPV as a decision making tool. If the NPV is positive, the project may be acceptable. And if negative, then it is not a wise choice to invest into the project. Okay. So compare NPV result across the different projects to determine the most beneficial option. Okay, so next is advantage. What is the advantage of NPV? What is the advantage of NPV? It is a very easy to calculate. Firstly, before making any decision regarding investment, if the investor knows how to calculate NPV, they shall be able to make a better decision. Next is it compares the present value of both cash inflow as well as cash outflow. Okay, as a result, the comparison provided the right perspective for the investor to make a right decision. Okay, NPV offer the user a conclusive decision. After calculating this, they will directly get to know whether to go for the investment or not. Okay, NPV offers the user a conclusive decision. Okay, so next is it helps investor consider multiple investment options irrespective of heterogeneous initial cost. Okay, project duration and cash flow patterns. What is the cash flow patterns? Is it decreasing? It is increasing by the time. What will be the demand and supply will play into this? What will be the maintenance of this project. This has been taken care by the net present value. It works in a collaboration with the metrics which as which as internal rate of return and payback period to provide a comprehensive and accurate financial analysis. So we can see here there are so many okay, so many advantage of this. Now comes to the disadvantage. The accuracy that calculation rely heavily on the precise estimation. We cannot rely on this always. Okay, so this is also there. If these estimated are unrealistic or inaccurate, the calculation could be deliver a misleading result. Okay, inherently it does not consider the scale of investment. For instance, two different projects might have a different initial investment, but the NPV calculation could deliver similar cash flows requirement despite different risk profiles and these projects. So for example, if 1 year project is giving me 20% discount and discount return, but one 7 years is also giving me 20% return. So it becomes a very unreasonable to calculate both of them or somewhere compare both of them because which is shorter. I will prefer this. Okay. Short term projects might have a higher NPV value, regardless of long term projects are able to generate more value over a time. This concept conveniently ignore the capital constant. Okay. So we don't think about what is the capital constant. It doesn't mean that if I think about the investment, the money will come within some time only. Okay. On available funds, which taking average investment decision. Okay, so these are the advantage disadvantage of the net present value. Now comes to IRR, which is known as internal rate of return. Internal rate of return. This is much more helpful when it is used to carry out a comparative analysis. When IRR used to isolation as one single value is less effective. Okay, it is often used to rank multiple prospective investment options that a firm is planning to undertake. Okay, the higher a project IRR, the more desirable it is. Okay, the project become potentially the best available investment option. The actual internal rate of return obtained may vary from the theoretical value calculated. Nonetheless, the highest value will surely provide the best growth rate among all. So we can see IRR is a discounted rate at which a project is return becomes equal to its initial investment. In other words, to attain a break-even point where the initial cash inflow completely meets to the total cash outflow, that is the IRR. Okay, that is a IRR. So we are going to talk about what is the difference between IRR and NPV. NPV was for one thing, and IRR is more of the comparison thing. Okay, so we can see here there are small differences between both of them. The net present value is a final cash flow that a project will generate potentially. That is positive or negative return. Whereas the internal rate of return is a discount rate at which the NPV becomes zero and reaches to some break even point. Okay, so this is here a point of investment into total cash inflow. Okay, total cash inflow. NPV values are required for calculating IRR. We need NPV values for calculating IRR. Next is the former is the method used to calculate the rate of return in the terms of percentage, while the latter measures how much value the investment adds for the business. Okay, so compared to the former, the latter is considered a better and more reliable measure while comparing the projects that are mutually exclusive in nature. Like NPV, IRR can result a complex and multiple answers to the problem and do have multiple decisions where we can choose between one or two projects. Okay. Now comes to the profitability index. We can see profitability index is a rule to obtain ration ratios that depict returns with respect to each investment. Hence, it enables companies to choose projects that are best value for money. So it shows the relationship between the company's project and future cash flows and initial investment by calculating the ratio, analyzing the project viability and calculated by 1 plus dividing the present value of the cash flow by initial investment, and it is also known as profit investment ratio. What I have made a profit divided by what investment I have made. Okay, it actually measures the capability of project investment to read profits. It also helps to compare between different projects and investment as well as choose the one which that guarantee more profit. So this is very beneficial for a company to understand the profitability index. The best thing about the index is that it allows businesses to compare between different projects whenever they require choosing one of the other. The projects having more chances of generating profit is a project that the time that the firm are likely to choose. Okay, that is a profitability index. What is the difference between profitability index and net present value? While net present value indicates the size of cash flow the business generates, but PI provides the percentage of profit expected from a project. PI allows the business to compare two elements or features or properties irrespective of the investment made in each, while NPV helps to obtain the results despite what investment would reap what profit. Okay, so PI is the ratio that lets individual and entities assess the percentage of the dollar to received in percentage of investment. On the contrary, NPV helps calculate the absolute cash inflows expected in the dollar. Okay, so that was my profitability. That was my profitability and budgeting, sorry, cost of capital definition, as well as, is there any questions into this? Okay, let's go to the another slide. What we are going to discuss about financial leverage. Financial leverage. Okay. Now we can talk about the financial leverage. What is the financial leverage? We firstly wanted to tell you about what we are going to learn about the financial leverage. Financial leverage actually involves using borrowed money to build the capital, expecting the income to be more than the debt. So, for example, if my cost of debt is 8% and I'm making a profit 10%, that means I'm getting a 2% profit extra over the time, and which will be good for my capital holders. Okay. So, what we are doing here, the financial leverage involves using the borrowed money to build up a capital. Next is the higher value of leverage signifies that the company has more debt than the equity. So in the financial leverage, we can also see that if I do have a more debt than my equity, that is a very bad condition where I could be at. The leverage magnifies the firm's profit while increasing the potential for loss. It is good option for companies, but it involves several risks, including bankruptcies also. So if I'm not able to pay my debt, my equity is not also covering it. So it become a very good chances where the company can become bankrupt. Okay. Next step comes to how does financial leverage work? What we do, how it goes. So when a company is highly leveraged, it indicates that it has more debt than the equity. In process of company borrows finances instead of issuing stock to investor to raise capital. Though the company can also use equity to build the asset, they prefer taking debt as the cost of borrowing is less than the cost of equity. So we can see here my equity profit is more than my borrowing cost is less. So I will prefer definitely gonna debt. Okay, financial leverage is an investment strategy where business borrow money to buy assets, where business borrow money to buy assets and increase capital to expand their venture. Firms opt for this option only when they know that their investment has potential to generate profit that could easily help them to pay back their debt. Okay, because in the equity, if you are not making any profit, that's fine because equity holder has a tendency to take risk. They are okay to make loss or maybe a less profit, but debtor will always sit there. Debtor will always sit there and ask for their interest. They will ask for their interest. Okay. As a result, cost of capital get reduced by the company. However, while debt gives a huge relief to the business for time being, it is a quite risky in the event of default. It might lead to bankruptcies also. Okay. So how to calculate the degree of financial leverage and what ratio we are going to calculate and what they are showing. So ratio that indicates is EPS, earning per share, to affect the fluctuation in the gains occur with the changing capital structure. Okay, so we can see here change in earning per share percentage divided by changes earning before interest and taxes. Before interest and taxes, that is the formula where we can calculate the financial leverage. Okay, next I comes with the financial leverage formula is, on the other hand, with regards to companies capital structure is financial leverage is equals to total debt divided by equity shareholders, your shareholders equity. So we can see here that total debt include my short term debt as well as my long term debt. So we can see here that that is debt equity ratio which can be calculated by the financial leverage. What is the effect of financial leverage? First, leverage could be effective way of understanding and assessing the financial risk of an organization might face, where we can see if the company can face a risk of paying their debt at a very high cost, but equity can settle for a low profit as well as for the loss also. So this is a very big financial risk an organization can face. This risk include everything related to monetary transaction issues such as taking up companies loan and defaulting. Moreover, if returns on investment are not as expected, investor might incur severe financial losses. Okay, so effect. What is the effect of this? When a leverage value is higher, the company relies more on the debt, more on the debt on equity. Okay, high leverage make lender offers loan at higher risk interest rates. So obviously, if you don't have that much property in your hand and you are going for the loan, they will definitely gonna give you a higher rate of interest. The bank is also always give works like that. Okay, as a result, the interest expense of a company increase, negatively affecting its finances. However, the value should also not be low, as it would mean company's reliability on equity is raising fund. In scenario where equity is more, the effect is adverse on the earning per share. Okay. So on the contrary, leverage could be effective way of understanding and assessing the financial risk of the organization might face. Next is example. I'm taking two examples here. First, company A has purchased asset and resources for the test order to be completed, the order received is likely to make a profit of $50,000. Does it decide to apply for loan instead of issuing the shares to investor? The company applied for loan of 20,000. As it knew the company built would have earned more profit, what is the need to be repaid? So what profit they are making? They are making 50,000 profit, and what the loan will cost is $20,000. So I'm getting $30 extra for $20. I don't want to make a equity share issue. Okay, so I am taking this decision on the daily basis also, and I can also see it is a long term or short term investment. Next, second example is here is a real life scenario where the debt and EPS of Nestle for 2 consecutive years. Okay, we can see here Nestle के debt से earning per share is there for 2 consecutive years, and leverage of calculated formula debt to equity ratio. Okay, so total debt was decreased in year 2004, sorry, increase in 2015, in increase 2015, and shareholders equity has been decreased. So we can see here the profitable that debt has increased and shares has decreased. Total debt of debt to equity ratio is also increased. So financial leverage in this case has increased by from 30.23% in 2014 to 34.05% in 2015. So it is totally depend upon the what is the profit I'm making out of my equity and out of my debt. And in the scene where I am making more profit than my cost of debt, that is the best way to take a decision. Okay. So any question in this? Do we have doubt in this? So I go to the next slide of cost of capital now. What is the cost of capital? It is basically what I'm getting out of my what I have invested. The capital can be created by the equity as well as debt or long-term debt. Okay. So what I am paying or what I am receiving as per my investment is my cost of capital. Is my cost of capital. We are going to discuss about the introduction, determination, calculation, example, as well as we are discussing the benefit and importance of it. So first of all, we are going to talk about the meaning first. What is the cost of capital? It is a cost of capital. It is a cost of capital Sorry, there is a call drop. Am I audible now? Okay. Okay. So we were talking about the cost of capital. I'm sharing my PPT. Okay. So the cost of capital accounts and enables a business to offset the cost of establishing a plant or purchasing machinery to facilitate business activities. It reflects the return on investment will generate the risk involved. Okay, so business source fund or such project through the debt or equity financing, that is, which becomes a company's cost. Okay, the equity financing is good, but the debt it becomes a cost to the company, or the equity financing where I am providing equity to the investment. Okay, so next I comes with the key takeaways. What are the key takeaways from this PPT? First is cost of capital is a method of accounting for the return on investment that helps an investor or offset to cost. Okay, next is it enables the investor to detect any risk or loopholes in the project that might lower their return on increased risk. Next, the weighted average of cost incurred in employing capital helps to know a company's value and risk for the investor. The higher a company's debt, the greater premium or return demand by the investor. Next is weighted average. Weighted average of equity and debt capital invested reflect the total premium cost a company owes to its investor for the risk taken by both of them. Okay, so we are going to discuss about these. What are the how to determine the cost of capital? How we can capital cost we can determine here. A basic way of estimate cost of employing a capital investment is to determine the break-even point. It is when a company generates revenue for the investment higher than the cost incurred on the amount of capital invested. A business also calculate a break-even point for investment in a project, its product line or subsidiary, etc. Okay. However, in case of borrowing of a company, the weighted average cost of capital formula is determined by the debt and equity sellout. Therefore, a weighted average cost of capital determines the weighted average of all types of debt and equities of the business on its balance sheet. So we actually calculate what return I'm earning out of my all the investment I have employed into my business. Similarly, investment in the research and development or innovation based project might have a higher cost of capital than a capital invested in a revenue generating operation. Again, it is because in the case of former, the risk factor of the investor might be higher and depend upon the success of the research or the innovation undertaken. Next come to the calculation. Next come to the calculation. What we are determining, the first step are determining the cost of debt. Second, we are going to determine the cost of equity. Now we are making an average of these. Okay. So how I have to go with the cost of debt? First, net average interest payable multiply by 1 minus tax rate. Why I'm talking about the tax rate? Because we have to pay some corporate tax, and this becomes this we saved when we are paying the interest. Okay, and divide by the total debt value. This will be my cost of debt. Next will be my cost of equity. What is the cost of equity? The cost of capital or for equity is much more volatile, represent as X. Okay, here we are talking about the X is my cost of equity, then the cost of debt. It is because the demand and supply market forces may play a greater role in determining the investor's return. Okay, if the company is giving 5% return and I'm getting a return from a FD is 7% or 8%. This is something I'm not able to uh, digest, that why I'm taking this much risk and getting only 5%. And if I'm getting return 20% into the mutual fund and I'm getting 5% from the equity, then I will definitely gonna switch myself. So that's why it is volatile, depend upon the demand and supply. It is not. And first is risk-free return, rate of return. First, I will say if I'm getting from the government bond 8%, 7%, then I will talk about the market rate of return. What is the market? What is the Nifty? What is the Sensex I'm getting? So this will be my cost of equity. When I do the weighted average method, what I do a weighted average method where we actually see the cost of equity and cost of debt divided by the what is the ratio of my total debt, total capital out of my equity is what is the ratio out of my total capital, and what is the ratio of my debt in the total of my capital employed. Okay, so this will be my weighted average cost of capital. Next, I come with the example. What they say, let us look at a cost of capital example, understand capital investment implication for a business and investor. For instance, Joe owns a coffee chain, Coffee Brew and Churros, CBEC, CBMC, and generate around 10 million annually from its own all chains. The business valuation CBMC B is 7.5 million and 2.5 million are the operating expenses. Thus, the market capitalization of stock holding drives it business value to book value. So here CBNB pays a cost of debt and equity capital from its earnings 7 million and recovers the cost from profiting the business exchange. Thus, the successful capital structure of CNB allows it to yield an increasing rate of return year on year for the investors because they are making somewhere a profit of 2.5 million, the earning cash flow. Okay, making a zero risk on the return type of investment for its investors. Subsequently, the enhanced trust and confidence have to let the investor, not to the demand and risk of the premium of the normal people. Okay, what is the importance of cost and what is the importance of cost of capital? Firstly, it determines the discount factor of the company's current cash flow. What I'm getting today. Okay. As a result, this facilitate the planning and executing of a future operations and project to continue generating profit. It helps businesses and or companies lower capital supplies cost by determining the best combination of capital structure. For instance, a startup might get a lower price on equity borrowing than the through the debt. So startup need to go with this. On the other hand, a strategic and well-planned capital structure can help a company to save cash flow as an interest payment or tax deductible and helps the company to reduce its taxable income also. So if I wanted to lower my income, a taxable income where I wanted to end up by paying less income tax, I will definitely go with the debt. Ultimately, well-maintained accounts for debt and equity cost allow investor to more accurate about the future returns. For a business, a comprehensively calculated cost of borrowing or capital can help them know the project maturity period and they can take measurable risks. So there is a very five conditions where we need to fulfill. Is there any question till now? Okay, next we can go with the benefit cost ratio. I'm sharing the PPT over the benefit cost ratio. This will be the last slide for this webinar. What is the meaning of benefit cost ratio? It is actually basically depend upon the relationship between the cost and benefit of project or investment. For analysis, it's shown by the present value of benefit expected divided by present value of cost, which help to determine the wallet viability and value that can be driven from the investment of project. So benefit cost ratio is somewhere a relationships, okay, which helps to identify most efficient product. Do I need to go with this project or another project? What is a more efficient project? So benefit cost ratio is indicator that allow firm to calculate expected cash flow to generate when an amount is invested in a project. It is study of benefit against cost to tell firm how fruitful a project would be in accordance with the expenditure made on accomplishing it successfully. So that was my benefit cost ratio. Okay, what exactly through significant rule it pay? It does not offer an accurate return value that firm would generate. It give you only an estimate. Okay, so hence firm have to validate the prediction by determining other ratios as well to figure out the approximate profit generation expected from the project. BCR, which is greater than 1, indicates the investment proposal will deliver a positive NPV. On the other hand, it shall have a IRR that would be above the discount rate or a cost of project rate, which is suggested by the net present value of the investment cash flow through the outweight of net present value of the investment outflow, and the project can be considered. So benefit cost ratio refers to the ratio of a expected benefit and the cost incurred. The value obtained enables entitles to learn about the return that they can expect out of a project. The BCR figures enable firm check on the project undertaken and find out the profits expected to generate it from it. Okay, so they can compute this ratio and determine the cost benefit of undertaking a project. Okay, formula. What is the formula for this? Firstly, present value of benefit expected from the project. So it does not include only the cost. There are so many benefits we are actually calculating here, and present value of cost of project divided. The mathematic expression that one calculate PC value is proper benefit ratio analyze. Okay, next. Is there any question till now? No, today is the last session. Okay, that was my last slide for the today webinar. Is there any question? Okay, by this I am concluding this webinar. Thank you so much for being an audience, and I wish you all the best for your future endeavor. Thank you so much.